Welcome, everybody. We're very happy to have you with us for our webinar on the fundraising journey, and really look forward to sharing with you some tips, guidance, and information on the topic. I'm Ben from the London and Partners office in Germany, and for those of you who don't know us or what we do, we help companies in London or outside of London grow in the city. But we also, it's very important at the moment, help connect the London ecosystem internationally to its counterparts. That's it from me now until the Q&A at the end, but I'm very happy to pass it over to Kimberly, who will be moderating the rest of the session. Over to you.
Thank you very much, Ben. I'm Kimberly Romaine, and I set up Private Equity Communications nearly 6 years ago to provide communications to support fundraising, branding, and origination. Prior to that, I spent 15 years in private equity reporting and research, so I'm very aware of the importance of companies making the right choices on their fundraising journey. Thank you for joining us on today's event. It will start with looking at the current fundraising landscape, basically some numbers and statistics on where we are today, because that sort of helps set the scene for where we think we might be going. We will then have three very experienced panelists who will talk to us about their thoughts and their experiences on what they're seeing now. We will then wrap up with a Q&A. You should see a chat box at the bottom of your screens, so please do use that for anything that you would like to ask, and we'll hope to get to that at the end of today's webinar, and if not, you will hear back from the hosts in a private email directly to you. To set the scene, I would like to introduce Paul Winterflood. He's a director in Moore Kingston Smith's corporate finance team, and he's got some useful data to share with us to provide this overview in London and Europe. Paul, over to you.
Thanks, Kimberly. I'm one of the directors in the Moore Kingston Smith corporate finance team, which is part of the accountancy network Moore Global. At MKS Corporate Finance, we help shareholders and owner-managed businesses grow their business, raise money, and ultimately exit. As a team, we complete around 50 transactions a year. Recent highlights include the sale of a major kids YouTube channel, the fundraise of a business called Influencer, which is an influencer marketing business. So a lot of our work is on around raising Series A investments. Each quarter, we publish a piece of research called the Growth Capital Report, which reviews the market. So we're going to use that to provide a backdrop to the session. So this report normally looks at UK private companies who have raised between £1 million and £20 million of growth equity capital. Given the European audience for this seminar, we've expanded our data to capture investment raised in the rest of Europe too, with a particular focus on Germany. In terms of deal types, the numbers in this report don't include senior debt and mezzanine debt fundraisings, as well as smaller fundraisings for companies, unless the amount is for more than £1 million raised. So startup money and startup funding and small grants and angel investments, which are often smaller than £1 million, aren't captured by this report. We also publish a couple of sector-specific reports. MKS, two of our core sectors are the creative industries, so we publish a createch version of the report, and we've also got a fintech report coming soon. So that's going to be launched in Q2. So watch this space if you would like more information about that sector in particular. So as I said, we've used this data to give an overview of the market, hopefully provide a backdrop to the discussion over the next hour. Next slide, please. So this first slide shows the deal volumes over the last 18 months, split quarterly, and analysed between the UK in red, Germany in blue, and the rest of Europe in green. We split 2020 not quite according to quarter, but in terms of a rough pre and post lockdown date. So we've taken a date in the middle of March as the date that generally Europe lockdown. I know in the UK we were slightly late on that, unfortunately. So I think looking at the data, there's a clear trend in this with deal volumes falling, although you'll note here that deal volumes have started to fall in quarter 4 2019. I think the in the growth capital report at the end of 2019, we were suggesting that the reason for the sluggish activity in Q4 and the slowdown was probably due to the huge amounts of uncertainty in the UK at that period of time, as the Brexit situation came to a head, as well as the election. I know a lot of businesses were very concerned about what the impact could be if, for instance, the Labour government had come in, and with no doubt that I think it's always been proven that uncertainty does reduce and does suppress deal activity. Now, I'm sure many of you will think that Brexit will know that Brexit isn't resolved, so there's still that uncertainty has been underpinning the market since 2016, but it really did come to a head in the last quarter of last year. 2020, you can see that the deal volumes did reduce even further, and that was across all of the 3 markets. Quarter 1 2020 in Germany was actually better than the equivalent quarter last year, which is quite interesting. So I'll be interested to hear Anthony's thoughts on that, as potential reasons for that. Post lockdown, as you'd expect, the deal volumes fell further, and I probably think the figure is probably inflated with a number of transactions which were already well down the road, completing in post lockdown. So I think if we look at I think when we see the Q3 numbers, it wouldn't surprise me if the deal volume did drop even further.
Well, sorry.
Go ahead, Kimberly.
I was just going to say, this is really interesting. Although you can see by the bars that there is a clear increase quarter on quarter in 2019 until Q4. Actually, the different geographies are different. Germany was quite steady Q1 and Q2, then grew a lot Q3 and maintains that into Q4. The increase and commensurate decrease was more rest of Europe and UK. So it really does depend on the geography, doesn't it? There's different factors at play.
Yeah, absolutely. And I think particularly when we're looking at the whole of Europe, you'll notice that the UK does make up a very high percentage of deal volume, so around 40% of the deals here. So when there is uncertainty in the UK, then that will have a big impact on the overall deal volume. And it does look like the rest of Europe too was suffering from a bit of a decline as well towards the end of 2019, coming into 2020.
Right. Thank you.
So on this next chart, we have the average deal value again split between the 3 regions and across the same period. So again, Germany is blue, the UK is red, and the rest of Europe green. I think the interesting point here is that the average deal values have actually increased in 2020. We'll come on to the different types of investments, the different types of investors in a couple of slides' time. But I think the core driver of this is likely to be the type of investors. The institutions are making up an increasing percentage of investments, and so they generally are investing higher amounts of money than a smaller investor would. I think the second point you'll note is that the deal size is significantly higher in Germany, so around 20% higher. I think maybe again this could be down to the different types of investors and different types of activity in Germany, which again we'll see on the next slide. More positively for the UK, the deal value has actually increased by 12% between pre and post lockdown. So think this shows for the right businesses, there's still a lot of institutional dry powder available to invest in businesses, even despite the uncertainty at the moment.
And Paul, I think that's a really crucial point, this dry powder, which basically refers to the committed capital that institutional investors will have raised. So unlike an angel investor, which may react more quickly to changes in the market, these people may have been in discussions with management teams for a long time prior to signing a deal. As times are tougher, there might be more competition for the most robust companies and management teams, and that could effectively drive prices up as you see a flight to quality by these institutionally backed VCs.
Absolutely. And I think that's absolutely the point. I think if looking at this, moving on to the next slide, you will see that particularly the VC investments by volume make up a really high percentage of the overall deal volume. So this chart splits out all the transactions into the various category of transaction. I think it's worth noting here that private equity growth and expansion looks very low, but that's likely to be due to the cutoff of the report. So we cut off the deals at 20 million, whereas a lot of the private equity growth and expansion deals, the deal value is higher than 20 million. So I would slightly discount that category, but here you can really see that the later stage VC, the early stage VC, and the seed make up a very high proportion of the overall deals, with angel investments and corporate investments making up a much lower percentage. I think as well, what we're not saying here is that there aren't angel investments, or there aren't a high number of angels investing in businesses. It's just that, certainly, I know that it's in the UK market, and I imagine it's exactly the same in Germany and the rest of Europe. Angel rounds are typically below the £1 million mark. So in terms of a funding journey for a business, typically the angel round, the friends and family round, will be absolutely crucial for the journey towards the Series A, but that will very much be for the sub £1 million investment rounds. Post £1 million is when the VCs very much get involved and would be interested in investing.
And likewise, at the other end of the spectrum, Paul, I imagine that because you cap this data run to 20 million sterling as the top end of deal size, as you said, that we can probably assume that the PE growth and expansion bar, third from the left, actually is probably a lot higher if you had a higher upper band. Similar with the later stage VC, because European companies, including the UK and Germany, tend to have a lot of international venture capitalists who would come in for later stage funding rounds, and those funding rounds can go into triple figures, which wouldn't be captured by your data. But yeah, I think what's important here is the fact that there was still a good amount of money going into these companies, and potentially even more than this would suggest.
Absolutely. So this final slide now, we've split the investment type again, but then looked at the total money being invested, and you can see here that the vast majority of the investments are from VCs in terms of capital being invested. Clearly, you'd expect that from the deal values, from the deal volumes, but particularly the late stage VC bar in particular now is the highest, which is actually as you'd expect. So I think this chart makes it clear that certainly for raising the higher investment amounts, the VCs are key. So for smaller investment rounds, my experience, angels and other alternative investments are probably the most likely source of funds until the revenues are high enough to attract the VC investment. I think this data, combined with the deal values, deal volumes, all point positively, and the fact that for the right business, investors are out there and looking for opportunities and keen to deploy capital, and that's certainly what we're hearing from conversations that we're having with the VC community in the UK. I think it'd be good to hear Anthony and Konstantin's perspectives as well on what the situation is in Europe.
Absolutely, and that is key to know that the funding and support that you can get from VCs and indeed other types of investors continues to be there if the opportunity is the right one, and particularly by virtue of the fact they have this dry powder to put to work. Thank you so much for those numbers. I think that's a really useful background. I think right now we can turn to some of our other panelists to talk to us about some of the things that they're seeing. We've got Anthony Tikhonov from equity crowdfunding platform Cedars, Konstantin Sapunov from BRL, and Harriet Rosethorn from Puma Private Equity. Anthony, would you like to start us off by telling us what your take is, because you've probably got an amazing bird's eye view at Cedars, on the current state of affairs for the very early stage area?
Amazing. Kimberly, thanks very much. It's a pleasure to be here, pleasure to be introduced. So my name is Anthony. I work for Cedars. For you to give you kind of a background, what we do at Cedars is the most active equity crowdfunding platform in Europe. We have about 1,070 financing rounds that we have done, and approximately 950 million euro invested into startups of pretty much various stages, starting from early seed stage up to Series B. We are a sector agnostic company. We invest across all Europe. That's why we do have that overview of a lot of things that are happening across all the different markets. And today I'd like to talk a little bit about this kind of what's going on in multiple European markets on the early stage financing, especially in Germany and in the UK in particular. So we all can probably agree that we are going everywhere in Europe and in the world. We're going through very uncertain time for both for the startups and the investors as well. But it's also very interesting and exciting time for opportunities. The first, probably one of the top questions. So I do speak to startups every day, quite multiple startups, and I ask them about conversations with other investors. And the number one question that all the startups now are getting, especially we're talking early stage startups, is the runway question. So the question is, do you have a runway of 12 to 18 months to go through that period or not? And there are multiple startups that do have that, but there are some of them they don't, because they were planning maybe their financing rounds in Q2, Q3 this year before Corona, or maybe in the end of the year. So what's happening for these startups? What are the options for them now? How does the situation look like now? So basically, the kind of the top level view is the situation is very different country by country. So you can really not compare the situation down in the south in Italy, Spain, in Germany, and the UK, because the impact of Corona has been very different. This is number one. Number two is there are very interesting development in multiple markets, but in particular in Germany and the UK, is that the governments have stepped up and have been really supporting the startups. And this is something that Konstantin is going to cover later on. But there are multiple initiatives here in Germany, for example, or also in the UK, for example, the Future Fund, that are now allowing companies, startups in particular, also in the early stage, to get access to capital. Then the next thing, what I also get quite a lot is when we qualify startups to raise on Cedars, we basically need them to have certain committed investment from other sources, be it institutional investors, angel investors. And a lot of the conversations that I have regarding angel investment is that when Corona happened, basically back in March, most of the conversations with angels have just stopped. They have been on pause. The angels said, hey, we are quite uncertain. We have maybe opportunities to invest capital in some other asset classes. Now we don't know what's going to happen. We're going to pause. The good thing is that the conversations are resuming now. So I have a lot of really positive signals in the market here in Germany, in the DACH region, basically also in the UK, that the conversations are back, kind of not maybe to back on track as before, but they are resuming now. Angels are eager and interested to speak to startups, to look at the potential deal flow and to invest. So this is a good development that I see. And another thing that's quite important to mention is Corona has hit different verticals in a different way. And this is also quite a straightforward thing, I guess, but there are certain verticals that are performing and will be performing now, will be a lot more interesting for investors of different times compared to other verticals. For example, med tech, everything related to remote work are the things that are kind of in trend now. That's a lot easier for startups to be in that vertical to raise and speak to investors, rather than if you're running a startup from the travel tech industry, for example. It's a lot harder for you to speak to and approach investors. But generally, the good tip here would be always think about the plan B. Plan B meaning, okay, when the kind of after the Corona time, what happens? How will you grow? What's going to happen? And have the plan B ready to explain to the investors. One more thing maybe to mention is the crowdfunding perspective. I do have really good view of that, because this is actually what we do. And it's also very curious to look at the numbers, because basically back in March somewhere, we did see a really drop in basically in investment activity, because a lot of startups, first of all, they said, okay, there is uncertainty. We are not sure if we're going to be able to raise on a platform. We're going to stop. At the same time, a lot of investors said, we're not sure we want to invest. We're going to stop. So there was a drop in activity in March, but the interesting development is that the activity now, basically in June and from the beginning of June, is back to normal, almost the level of last year, even overperforming the level of last year. In addition to that, the success rate has gone up by 4 percentage points compared to basically last year, which is also very interesting development. And it all seems to kind of, the whole trend is showing that crowdfunding could be a very interesting way to go for specific types of startups during this uncertainty period. And maybe the last thing I'll wrap up my little speech here is that what I have really seen in all these conversations with hundreds of startups over the last 2-3 months is that I see there's kind of a so-called a new type of founder emergence, so to say. There was founders that I was speaking to before in March. They were really uncertain what's going to happen. They didn't know. But the people that I'm talking now, they know Corona is here. It's kind of here to stay. There's new reality. We have to work around it. We have to adjust our strategies. We have to adjust our financing strategies. And those are the people that will be successful in their fundraising, in running their business. Those are the ones that accept this new reality and ready to kind of pivot and change their strategies here. So I'll kind of wrap up here with this note, so to say.
Thank you very much for that, Anthony. It's really interesting to note that the people who are going to do well are the ones that are accepting the new reality, able to pivot. And as you said before that, what is the plan B? What are you doing now? Because so many people were focused in the first month or two on battening down the hatches. Actually, you need to think about your plan back to growth, because without that, what are you going to do? And if your competitors are doing that and you're not, then you're already on the back foot when you can re-emerge from this. Constantine, I imagine you've got some interesting insights to add to this, given where you sit at BRL.
Hopefully, and also from my side, thanks a lot to the organizers and thanks for inviting me. Now, it's a bit complicated being the second one after Anthony, who gave a great speech and informed us about several things I had in mind too. Perhaps just a sentence. As you said, my name is Constantine and I'm working with the law firm called BRL. Our firm is not only consisting of lawyers, but also of auditors and tax advisors. We are approximately 300 people in Germany, and I'm working in corporate and M&A in Berlin with a strong focus on advising investors, startups, and growing businesses. Let me put it this way, from funding to financing until the exit in the best case. And I was asked to try to share some information with you with regard to fundraising trends in Germany, at least with regard to early stage investments. Anthony informed us very well. I thought the best way to inform you is to let you know what we did over the last month and or what we have seen. We all know that the startup business has been affected. Numbers are changing a bit, but the last survey in Germany pointed out that approximately 60% of the German startups will definitely suffer from a financial point of view under this crisis. And as Anthony said, in particular, also according to my experience, the early stage ones having a quite low financial reserve and being nearly, for them, it's nearly impossible to get funding, for example, by loans from banks. So that's why professional venture capital investors are so important for these kind of companies. What we saw is a more, a more selective approach towards new investments. So several of our clients are, due to the actual situation, perhaps more focusing on existing portfolio companies than investing in new companies. That's definitely one point. What we saw as well, and Anthony mentioned that as well, we saw a high level of, now I'm talking about the startups or the companies being clients, a high rate of reflection on the business model, and also a high capability to change processes, perhaps to reconsider distribution, so rechanging the business model due to the actual circumstances. What was in this crisis time interesting, and in my opinion quite healthy, because people were not only working on how to survive, but also in a very proactive way on getting their business, trying to getting their business better. We, as you can imagine, we supported a lot with regard to cutting expenses, short-time work. I think we all know what we are talking about. This is sad, but it was necessary. I think we all agree that funding at the moment is insufficient. The several governments in Europe reacted with different kind of speeds. I think France, UK, and Germany are very good examples what can be done. There are some other countries, I'm not aware of any governmental aids. So we worked a lot, as Anthony said, on supporting our clients with regard to these financial aids. The German government put together a package of 2 billion euros. The system is very good, but the conditions and criteria are still difficult to handle. So at the moment, no one is sure what will come up next, how to handle the criteria, how to apply for these aids. So we are working quite a lot on that, and the situation remains a bit insecure. In particular, as the relevant information, now I'm again talking about the startup side, it's difficult for the startups to get the right information, how to apply, whether they fill in, whether this is applicable to them or not. So this is quite difficult, and that was a huge part of our work over the last month. Nevertheless, we had some financing rounds. I have to say that most of the terms have been negotiated before the crisis, so there was not so much change. I'm sure you are aware, or some of the people who are watching us are aware of the fact that in Germany we have had some quite huge financing rounds over the last weeks. N26, we had Brighter in legal tech, we had ZenJob, we had Zender. So there are things happening. What makes us confident, although the times are turbulent and remain turbulent, we expect some changements with regard to terms, but later on. I'm quite sure that we will see some so-called down rounds over the next month. And I'm quite sure that we will perhaps see some changements with regard to terms in shareholders agreements, in particular, for example, with regard to liquidation preferences, as liquidity is for now the most important thing.
Thank you, Konstantin. I think it's one of the crucial takeaways from what you've described is the fact that VCs remain important. They're taking a very professional approach to how they're doing this. There is funding, be it from them or maybe some of the government initiatives, but it's quite hard to find out what is available. And that makes the role of advisors presumably more important now than ever, because you can help companies to wade through this. What are the opportunities? What is the best one for you? Because you might qualify for a number, you might be attractive to a VC, maybe you prefer to go to a government aid initiative, but it's really about marrying the long-term growth plans of the management team of that company with the long-term implications of the funding that they choose to take on. Harriet, you are the only private equity representative on the panel. I imagine your experience, therefore, is less bird's eye than, for example, Anthony, Konstantin, and Paul may have had, and more in depth with specific companies, which you may have been in discussions with prior to lockdown, may still be in discussions with now. And I know that Puma just announced a deal last week, so you really are reporting from the front line, so to speak. Can you talk to us a little bit about how things may have changed, or maybe they haven't changed? How have your discussions with management teams evolved over the last couple of months?
Sure, and thanks, Kimberly, and thanks for having me on this webinar. It's great to be here. So I'm an investment manager at Puma Private Equity, and we typically invest £2 to £10 million in growing SMEs that normally have a presence in the UK. We work across a wide range of sectors, and our experience is primarily on scale-up scenarios. And it's really about supporting those businesses grow from the sort of £2 to £10 million revenue range to that £10 to £30 million revenue range. And it's about leveraging that experience in the scale-up world to support those businesses across those sectors, because a lot of the challenges that they face reaching that next level are surprisingly consistent. In terms of the current funding market, there's still a lot of uncertainty out there, although I do hopefully think that that's starting to ease somewhat with things reopening and getting a little bit of confidence back into consumers that there might be a new normal. And I think a lot of funders, as you both mentioned, Kimberly and Paul, have capital still to deploy, and that's true for us as well. So there is still definitely a market out there to access for scale-ups to access that funding. And as Kimberly mentioned, we recently closed a deal, a £5 million investment into a business called TickTrack. And we were talking to that business prior to lockdown. But we remained very positive about the business and really, spent a long time with management developing that relationship, and really committed to supporting that team on their growth journey, and therefore continued to put money into that business and support that investment. And actually, as a team, we're still working on 2 transactions at the moment, which are in due diligence phase. So there is definitely still sort of funding going on, despite kind of initial thoughts that people might be focusing more on portfolio versus new investment. I think that's starting to change a bit now, as we see, as we can better assess what the impacts of this 12 or so week period has been. And I think for a business that is looking at scale-up funding, the point remains that the most important thing for you is to pick the right investor. And you should really make sure you know their fund, their mandate, and what they're looking for in their portfolio. Everyone has their strengths and weaknesses. And as Kimberly mentioned, I think the role of the advisor in this is really important, because the advisor should really know you and your business and be able to point you in the direction of what works for you and your growth trajectory. And actually we worked quite a lot with Kingston Smith when we invested into Influencer last year, which is a business that they supported on that journey, and that was a great relationship and really helped us make that transaction as smooth as possible, and has ensured that the relationship continues strongly to this day. And I think, you know, it's important to take that time to really get to know the team that will be investing in your business, because it's not kind of a short-term thing. You'll be working together sort of 4 to 7 years, or however long their hold period is, and you need to know how that investor is going to support you on that journey, and what experience they have, and what they'll be able to add to you as your business grows and reaches that next phase.
That all rings really, really true, Harriet. And I think what you said about the role of advisor being important, and the fact that you've had positive experiences of working with advisors, just as you as a private equity firm are going to do immense amounts of due diligence prior to giving a company millions of pounds, they should be diligencing you, shouldn't they? Because when they're doing initial meetings with private equity firms or venture capital firms or angel investors, you're all going to sing a great song and do a really nice dance. It's about knowing, my plan is to grow through M&A. This person says they can do M&A, but who's actually got an excellent track record in doing M&A? And that's an area where an advisor might be able to say, well, actually, they've worked with these various companies. You can ring these management teams up and speak to them. It's also about mapping the market. Who has money right now? Who offers certainty of execution in terms of being able to actually write the check when you go to sign the deal? Because it's about having that committed capital ready to deploy. And a lot of the institutional community has that, but not necessarily all of it. And that's where an advisor can probably really help to work alongside management teams to devise a shortlist for them of people who are definitely proceedable.
Yeah, definitely. I would agree 100%. And you should always be, you know, meeting lots of advisors in when you're picking one to go forward with, and as well as meeting investors, and really get to know the people, because often they will be sitting on your board. They're going to be seeing you every month. They're going to, you know, if you have a problem, you should want to pick up the phone to that person, and that's really important. And I think it's about developing that connection, that relationship, and that's supported both through kind of the business and the investor themselves, and also the advisor and the business themselves.
Absolutely. Thank you for that. Anthony, were you putting your hand up?
Yeah, I'd just love to add to this, because I do believe that this is a super critical and really important point for startups, pretty much every stage, to understand. And it's amazing that we're covering that. Just to kind of add to all the points, absolutely agree with what you're saying in terms of communication with the investors, doing due diligence on the investors. It's not just one way, it should be two ways. And there's also one little tip that I do appreciate quite a lot is it's very important. Kimberly, you have mentioned, but maybe to go a little deeper on that one, it's really important to talk to the portfolio companies of the investors and speak to the portfolio companies, not only the ones that are succeeding and doing good, but also to the ones that possibly have failed. How was the communication with investors? How was the process? How were they? So it's really understanding what are you committing to in terms of this very long-term commitment for the next 4, 5 to 7 years.
Okay, yeah, a lot of people that I've worked with over the years and met with on a number of occasions and built up relationships, they're joking, but actually there's an element of seriousness to it, that a relationship with a backer, a long-term backer such as a VC or private equity firm, can be like a marriage. I mean, Harriet said that you'll see them every month. A lot of them, particularly in the first 100 days, and if and when you pivot your plans down the road, you're going to see them a lot more than that. You're going to speak to them very regularly, particularly if you decide to go down the M&A route. You will be traveling with them and meeting with teams. So it is completely crucial, and always has been, to get the right backer on board. But now that might be trickier because we can't have as many face-to-face meetings. We can't travel as easily. Harriet, you've just signed a deal, but you did mention that TickTrack, you were in discussions with the management team prior to lockdown. Would you, and Paul, Constantine, Anthony, would you advise that people do a deal without actually meeting up first, face-to-face in the flesh?
Yeah, this is something that we've been discussing a lot of it as a team, and I'm not sure we've actually come to a firm conclusion on it yet. To be honest with you, everything that we're sort of working on at the moment is we've met the team pre-lockdown, so we are aware of kind of the personalities that are involved. We are obviously speaking to businesses that we are hoping to progress with to the next stage, but with the anticipation that we will meet up at some point. I think it is very important to meet someone face to face. Obviously, video is a great medium and has worked incredibly well, and technology has not failed us yet in this regard. But I do think, you know, meeting that person face to face and going out for a lunch or something with them will kind of help and really help you get to know that person. But I'd be keen to get other people's thoughts on that.
I would completely agree, because also from a legal perspective, there are, and for whatever reason, often quite important points that are discussed, for example, at the day of the notarization. So people are sitting in front of each other and then clearing up some remaining open issues. So seeing each other and sitting in front of each other is, according to my experience, quite important. Nevertheless, over the last month, for several clients, we were signing deals on the basis of POAs together with all the other lawyers sitting in front of notaries. What is medium fun, quite productive, but it changes a lot. And so I'm sure that, as you said, for long-term relationships, it's important also to share this final moment of the deal signing, because this has a huge psychological impact, I think.
I think the key thing at the moment is innovation is so important, and I think certainly for the investors we're speaking to, people are finding innovative ways to have the face-to-face meetings. I think I heard from one investor that they needed to see the senior management team, so they went for a socially distanced walk. So it might not be they may not be able to meet in a meeting room, but I think people are finding ways with everything at the moment, just finding ways to make things work. But the key point, I think, in challenging times in particular, chemistry is even more important. Having alluded to the point that you need to be comfortable with they want the company that they're investing in to be comfortable that they can pick up the phone at any point and speak to them about any problem. The phone is probably less likely to ring when times are great and everything's going all guns blazing. But at the moment, with so much uncertainty, it's even more important to have an investor who you get along with, and you can work well with, because I think it's likely to be turbulent for the immediate future.
Anthony, do you want to add to that?
Yeah, if I may, thanks very much. Look, I do have a little bit kind of different view, because the way we do our business is also a little bit different to all of the colleagues here. We are kind of pretty much all online platform. We've built a product that is purely online, that is allowing startups basically raise capital through the product online for investors without meeting them. And in my role, basically my job every day is I'm catering to 20 plus markets basically with my team. So I'm always on the meetings, on the calls, usually on the calls, because the efficiency is there to speak now to somebody from Lithuania, then somebody from Italy, then maybe somebody from south of Germany, and so on and so forth. And we have seen also during the lockdown, we've been able to completely start and completely close multiple deals already in a non-face-to-face measure. The chemistry part that Konstantin and Paul have mentioned they are also super important for everybody pretty much. We all human beings, right? We all have the psychology behind it. But I'm pretty sure that like going forward, a lot more investors will be looking at kind of more efficient, more streamlining the communication process through multiple technologies like video technology and stuff like that.
Great. I'm aware that we actually have quite a number of questions coming in. So unless any of the panelists have anything to add to those final points, I might hand it over to Ben, who introduced the session, to start answering some of these pressing questions.
Yes, hello again. Yeah, we've got some good ones have come in. There have been two linked to revenue. So one of them was, what revenue levels do you need to achieve to start attracting VC investment? And then linked to that, another question about how important is profitability in comparison to revenue, or what's more important or not.
So when we're working with companies that are thinking about doing a fundraising round, particularly when they're wanting to do a Series A or get a VC investor involved, we say generally the rule of thumb is that you should be looking for a sort of £1 million worth of run rate revenues as a minimum. That's not to say that's solely the only metric that's looked at. Certainly other KPIs are important. So if companies are building a user base and can link those user metrics to future revenues and then future profits, then that's clearly important, and those KPIs will be looked at. In terms of profitability, it's I think for that stage of company, profitability, it's not expected that the companies will be profitable, but there certainly should be a pathway to profitability, which is evidenced through both through the deck and also through the financial models. And it's important that you can show a credible plan to get to profitability.
Thank you, Paul. Ben, should we move on to the next one?
We had a question which came in before. We had a question which came in before about, as we move towards the autumn, is the panel expecting a spike in successful applications for funding to make up for the hiatus in the spring and early summer?
That's a good one. Yeah, Harriet, would you like to talk us through your thoughts on that one?
Yeah, I think, I mean, I don't have a crystal ball, unfortunately, but I do think that there will be, I've spoken with a lot of companies who have kind of been holding off, in the sense that, you know, if they've got sort of supportive existing investors, that they are seeing what they can do if they need some sort of cash now, that they'll do some sort of bridge funding with the anticipation that later in the year, when maybe we're seeing some of the market has recovered, that they will come and look for that bigger round that they might have actually scheduled in for earlier this year. So I would say that we might see that. I think we've actually still seen quite a lot of businesses coming looking for funding, and so our deal from an origination perspective, our deal values and volumes are from on our CRM system are still relatively close to what they were last year. So it's not been, you know, there's not a huge change. I think that there might be a surge, but I would say that investors will still be quite keen to stick with their mandate, and they're not going to sort of force money into businesses for the sake of it. And it will still be very important for those businesses to meet the criteria of that investor. So yeah, I think I don't know if I really fully answered the question, but I think we'll have to see, and I think there'll still be lots going on, and there's always a market for businesses which are growing and showing you know, strong track record.
And I think that particularly in later stage opportunities, so just remembering the graphs that Paul shared with us at the beginning, as you get to later stage, there's probably so much diligence that goes into each deal, and the relationship is going to be a very long-term one. It's an opportunity to grow with a company. It's not like betting on a stock market where it's very quick and very liquid. And yeah, that goes back to the marriage analogy. You're in it for a long time. And so if you believe in the growth plans and ambition of the management team, and you feel that they've reacted well to the current situation, and they have a sensible plan back towards sustainable growth, then there's every reason that that opportunity should come to fruition. Anthony?
Thanks. Well, the only certain thing that we can be sure about that is the future is uncertain. We cannot really predict it. But based on the conversation that we're currently having, and this is kind of with the investors, with basically, I'm talking early stage now because this is the view that I'm taking in this panel, with angel investors, that is kind of the first professional money, maybe early stage VCs as well, is that the conversations are back in place, they are happening, and there are quite a lot of indicators that there will be, the deal volume is going to be increasing now, going kind of, it's definitely not going to be the same level as it was last year, because generally all the numbers, if you look at the trend, investment trend across multiple European countries, what Paul was mentioning, but on a kind of more long-term perspective, it has been really over the last 8 years, it's been really going up and up and up in the number of deal volumes and all that kind of metrics. But so we've seen the drop, and the anticipation is going to start crawling back up again, but how much, and nobody can actually answer that, but there are positive signals for sure.
Cool. We had a few more came in. So another kind of good one for all the panelists. Should pitch decks change as a result of COVID-19?
Does anybody want to handle that one? I suppose, Harriet, you look at a lot of pitch decks. What are your thoughts on that?
Sure. I mean, I think obviously we'll expect to see some sort of reference to how a business has reacted to the period in COVID-19, because it's affected everyone. I don't think that anything should change unless your business as a whole has changed. And I think it's going to be very business specific answer. It's really got to be any changes that you made to your business, how it's impacted you, lessons that you've learned, and it's sort of an ode to COVID in some aspects, but I think it will depend on the business and how you've reacted to it.
Anthony, did you have anything to add to that?
Yeah, just a little remark. I do believe that pitch decks and basically businesses should be talking a little bit more in terms of scenario planning now, because of that uncertainty that we're talking about. We're not sure what's going to happen next month, especially it's the case for specific industries that are very uncertain, like travel industry, for example. Like there is so many different projections on when people actually will start traveling, well, when the airlines will start flying in full capacity. So there's lots of uncertainty in there, and it would be great to have certain scenarios there more than it was before, because we had relatively certain future before. So it's ABC scenario that is definitely going to be helpful. And one more thing probably is the kind of the plan B. What if we're back to normal? How are you when you're pushing basically the full foot on gas pedal? How it's going to happen? What's going to be happening? And are you ready for that?
I think those are interesting points, Anthony. One thing to throw in there is that I don't feel it was that certain prior to COVID, because actually what we did see, particularly moving up the value spectrum in terms of later stage VC and some of the growth and expansion deals, and even into the leverage buyout sphere of things, valuations were really, really going up. And some people were starting to talk about the fact that we were in another bubble. So prior to lockdown, prior to COVID, there was some talk of the fact that there might need to be a correction. And so people were still investing, people still had lots of dry powder to put to work. But I don't think it was entirely smooth sailing prior to this. I think some people were getting quite cautious.
We had another question which came in earlier. Why do fundraising processes take so long, and are they taking longer? They can be a big distraction for management teams. How can this be lessened?
Paul, do you want to give us your thoughts on that one? Because I know that you see a lot of these.
Yeah, absolutely. I think it depends on the type of investment being sought. So typically, I think that the Series A process in particular is one that does take a lot longer than people expect. Certainly, 9 to 12 months isn't uncommon. So definitely sort of worth bearing in mind when you're sort of planning out your roadmap for raising money. Certainly, quite a few companies that we work with, it's often they're considering alternative investments, crowdfunding as a sort of as a bridging round to get to the point where they're big enough, they've got enough traction to carry out to do an institutional round. I think in terms of why it takes so long, we clearly discussed the length, the cultural fit, and making sure that is right, and that process does take a long time. You can't assess cultural fit on 1 or 2 meetings. Unfortunately, it takes several weeks and months of conversations to assess that. And if you also consider you're likely to have multiple investors looking, or having conversations with multiple investors, then all these blocks all add to the length of time of the process. Then, from an investor's perspective, once both sides are happy that they're for the cultural fit, and you've got a term sheet on the table, then diligence starts, and diligence is pretty time consuming. If you're a SaaS business, for instance, you might have commercial, technical, IT, legal, financial, so multiple streams all going on at the same time, all adding time to the process. They then got a contract negotiation, which is a very important document, so which sort of sets out the rules of engagement and protects both sides. And then if it's a tax advantage fund, then tax clearance will also be needed, which I think tax clearance in the UK for if you've got a VCT involved, I think you require sort of draft legal documents, and then it can take sort of 2 to 3 months for the tax clearance to come through. So all of these things just add time to the process. So I think planning and allowing, we talked about scenario planning. So think about, okay, if the investment takes 6 months to get the investment in, what would this look like for my revenues and my model? If it does take 12 months, do I have enough cash? Do I need to adjust the what I'm spending money on, and maybe slow down the rate of expansion slightly to make sure that I don't run out of cash just before the money comes in?
Understood. So it's a necessary process. It's going to take that long. I mean, you're saying 6 to 9 months. I definitely know of processes that have taken literally 2 years from initial conversation with an advisor. But that was because it was a large deal, to finding a long list, whittling that down to a short list, and then spending months, enjoyable months, but months playing golf, going shooting, because it's the relationship building, and that's before you come to diligence. But that's necessary to ensure that you get it right, I think.
Absolutely.
And in general, the lawyers are responsible because they work too slow.
Ben, have we got time for one more question?
Yes, we had a good one about sector bias, and we've kind of addressed it before, but I think it'd be good to wrap up with a question on, will we see more sector bias now post COVID-19 from investors?
Anthony, have you seen any signs of sectors that are hot and sectors that are not now?
Absolutely, and I think I've mentioned this briefly before, and there's definitely sectors that are forecasted to be quite hot and interesting and sexy for the investors, and sectors that are kind of put on hold in a way that, like, there's just too much uncertainty. Like, again, what I have mentioned before, medtech has really, you can see it, the numbers and the interest in medtech. It's just so many deals, which is like, I just read news today, there was a huge 300 million investment here in Germany into a medtech company doing kind of something related to a vaccine against coronavirus, for example. It's a huge number that they probably have never expected before the situation. Everything that is related to remote work and productivity, because lots of teams are moving in that area. We see quite a lot of really strong interest from investors in that space as well. But at the same time, again, I have mentioned this, travel is something that is definitely airline related, travel related, something that is definitely going to be in a little bit more trouble, so to say, where we need to really understand how do we deal with that.
And I think those are some immediate observations, given the fact that there'll be certain sectors that are very hot right now. As you say, if you're a med tech company, which is able to provide some hopeful solutions for the current situation, and there will be some consumer facing businesses which are out of favor right now. But I think an important thing to remember is that a lot, particularly in the institutional side of fundraising, a lot of the professional investors will have sector specialisms. So they might have experience in a particular sector, and they might therefore be able to develop an angle of how to work with management to grow a business in a certain way, which won't go away just because of the current situation. So I think that's my way of saying there's hope. If you're a company listening to this and you're not necessarily a med tech company, it doesn't mean that you won't find investors interested in you, not at all. I think we've run out of time. I think there's been some fantastic takeaways from this. Just some notes I took. It's important to remember that for the right business, there is appetite out there, whether it's from an institutional investor with committed capital ready to put to work, or whether it's from an angel who may have paused a little bit at the beginning of lockdown, but are now beginning to resume looking at investment opportunities again. And that, for whatever type of investor it is, it's crucial that you have a strong growth plan to show that you've got your ducks in a row, you've got your business into a robust position, but that you've pivoted if that was needed, and that you have very much started thinking about what your business is going to look like from now going forward, because that'll be crucial for investors to look at, to really reflect on the business model. So all of that said, huge thank you to our panelists for their insight and taking their time to enlighten us. Thank you to the hosts for putting this together, and thank you very much for those of you who've joined us. If you had a question that which we were unable to answer, given the time restraints, I apologize, but I do believe that the organizers will come back to you. Finally, a recording of this will be sent out to all of you who have been on this call. So if you wanted to re-listen to it for whatever reason, or forward it to a colleague, please feel free to do that. Thank you.